Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Good morning, Dodger. We've seen the weakest ever reading on wage growth that actually sent the 10-year yields to a 3-week low. How will this affect interest rate decisions by the Fed?
Good morning, Julian. Well, robust growth really does remain elusive over here. The Fed wants to see wage gains pick up to a pace stronger than the underlying inflation, so consumers feel comfortable spending and committing to big-ticket items like housing. Stronger wages also would be a sign, but we're not seeing that. It means that the next two employment reports before the Fed September meeting will take on outsized importance for policymakers. It would be better if we could start the process in September, but not do much for the rest of the year and hold off or have very low increases. But now it does throw into question whether or not they will start. I think this year is pretty sure, regardless of what happens from an economic point of view. But we have to watch, and the words that are being chosen are very important, to the point where even our family is beginning to adopt the Yellen strategy, and my wife is going to be holding weekly meetings with our children so they can hear exactly what the impact is over their future allowances.
Hopefully your wife is not as cryptic as Janet Yellen. I'm sure she wouldn't be. But Dodge, if we look at the wages and hourly salaries, wages and salaries for labor, we've seen that it's really struggling to arrive back at the pre-crisis highs of '06 and '07. And this is on the background of a lot of positive commentary about the economy and also all the trillions of dollars spent under the QE. Do you think that the U.S. economy is really on the mend?
Yes, no, and maybe so. Yes, it is on the mend. No, it is not as fast. I think this full employment, where we are relative to what is considered full employment, is very misleading. I do not think we are as strong as the numbers, the relative position of employment now implies. But I do think it's more solid, and it is a definite trend. One of the things we have to watch is what's going on in the rest of the world. But for now, there is improvement, but we have so far to go, and it is much slower than expected, and that really will hit upon interest rates. I think we're going to see a much longer extension to increasing interest rates, but I do hope that they start in September or more likely now December.
Mm-hmm. And as far as the Treasury's rally is concerned, this is on the 10-year bonds. Has this got anything to do with the weak wage growth, or is this linked to the US dollar as a safe haven, do you think?
A little bit of both. I mean, short-term U.S. Treasury rates backed up to levels not seen. That's true. And that's likely on the belief that rates can only rise very gradually under the current subdued growth outlook. So that's more tied to our interest rate scenario. U.S. economic data certainly does not support the 2% inflation target at this point. It's still that 2% is still out of reach, and the labor market may not be as healthy as the low unemployment rate suggests, which is what we believe. The Fed only has direct control over short-term rates. Longer-term rates are really based on the market of buyers and sellers. And so we expect that there will be a build-in of higher interest rates, but not as soon as what is expected. What we're going to be seeing going forward for the next 3 to 6 months is high news, low trading volume. This could result in extreme volatility in the Treasury market. Now, Treasuries are not known for volatility, so when I say extreme, it's not as extreme as what you would expect in stocks. But relative to what we've seen in Treasuries, because we're going through the high news, low trading volume, there will be more volatility. And that volatility will be based a lot on what's happening outside the U.S. The U.S. Is one of the few alternatives now where you can invest and have some kind of yield with some kind of safety. There really isn't much of an alternative. You have Europe and Japan, you have gold. None of those are really offering the same type of relative performance. So that's the longer-term implication, that right now there's a lack of alternative that's helping the U.S. rates go down.
So, Dodge, if we look at the performance of the US dollars against its trade-weighted basket of currency, the US dollar has actually strengthened about 20%. Now, how long can this go on, since this is actually affecting the US economy?
No, boy, that's a good question. I think that it will go on for a while, and it will be driven more by what's happening outside the U.S. as opposed to what's happening economic within the U.S. If the U.S. can continue to function economically with a perceived improvement, yes, it will not be as much as one would hope, and no, we're not close to the 2%. Then I think that you will see the U.S. dollar as being the dollar reserve and as being the currency of choice. So I do think it will go on for some time, but at some point we will, as we transition out stock markets being valued based on low interest rates versus what they should be, which is fundamental progress, as we transition away from the valuation of dollar based on lack of alternatives, then I do think the question will be which comes first. Is the U.S. economy strong enough to support continued growth, or does this transition occur before we're ready to transition to economic valuations?
So we have a lot of positive things baked in and thrown into the mix. You got the strength of the US dollars. Also, the stock markets have scaled new highs, and Microsoft also is reportedly valuing Uber at over $50 billion. What are the odds that there is a bubble, and what are your odds that the market will continue to go up?
Now, Julian, take a look at the markets. Yes, the generals are doing very well, except for the Dow, of course. Yes, there is some real leadership, but the breadth of the advancing issues is now declining, and that's what you would typically see in a maturing bull market. So you have to really choose your stocks very carefully to continue to participate in the up move. And you don't see it across the board. The Dow is undergoing, or at least in our markets, the Dow is undergoing some real weakness now.
Isn't there some kind of correlation to the general market, so that if there is a prospect of, let's say, a crash, isn't buying into any stock at all a gamble right now?
It may very well be a gamble depending on the timing. But in this type of market, it does not pay to anticipate the end of the bull market and a crash, because you're leaving a lot on the table, and one doesn't know. Right now, the volatility that we're seeing is being based extremely on news-related, not fundamentals of the markets, but on news-related items that's happening over on your side as well as our side. So I think there is still time to enjoy the strength of the markets, but one has to choose the stocks, and one has to be ready to adapt and adjust to a potential downturn.
Thank you. That was Dodge Dorland, Chairman and Chief Investment Officer at Landor and Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6.